I'm about to review why the traditional old school 3 fund portfolio might not be your best option anymore and how a modern alternative portfolio can significantly outperform this one. And I will dive into data backed comparisons and break down the ideal asset allocation for each decade of your life, from your 30s to beyond, showing how this new approach can improve your returns and offer better safety during market downturns. Because when I just started out in the financial industry 15 years ago, I was amazed by how some normal looking people accumulated such massive wealth. I wondered, what's their secret? And after digging deeper, I realized it wasn't just about saving money. The real key is the right asset allocation and maximizing your returns on the investments. A difference of 5% or 10% in returns over 30 years can lead to a huge difference in wealth. And the most successful investors excelled by making smart asset choices. Because over a 10-year period, when you have had invested $100,000 in VOO, it would grow to $337,000. But if you invested 50% in FOO and 50% in a bond ETF like BND, you would have $201,000. That's a $136,000 difference. This is the reason why in this video I will address a common misconception that you need a 50-50% asset allocation to be safe. And therefore, I will also review this new alternative 3 fund portfolio that outperforms the traditional one, supported by important data. And this is really important that you do this the right way, because I realized that anyone could achieve millionaire status if you invest your money the right way. So today I want to show you how straightforward this can be and why choosing the right asset allocation by age is so crucial. But first, before we dive into this topic and give you the answer, it's important to understand the structure of the traditional 3 fund portfolio. So how does the traditional 3 fund portfolio look like? So I break it down for you in easy steps, and when you think it's too complicated, please stay with me because I will explain it really simple to you. And it's really important you get this. The classic 3 fund portfolio typically includes 1. A large allocation to the US stocks, for example, the VTI or the FOO. 2. A smaller portion in international stocks, and you could think of the VXUS. And number 3, a segment in bonds. For example, one of the most well-known bonds ETFs, the BND. And I always explain it to my clients as follows. Investing is like planning a long road trip. You have to look for the right balance in your portfolio, and this is similar to having a well-maintained car with both a gas pedal and a brake pedal, ensuring you can navigate the journey smoothly. And just like how the brake pedal helps you control your speed and avoid accidents on bumpy roads, bonds are the safe investments in your portfolio that help reduce risk and smooth out the ride during market downturns. They provide stability when the roads get rough and preventing sharp declines in your portfolio's value, right? However, there is a trade-off. If you are young with many miles ahead, relying too much on the brake, loading up too much bonds can slow you down significantly on the long run. So, mainstream advice for the 3 fund portfolio suggests that when you are in your 20s or 30s, you should keep a low percentage in bonds, such as 5%, 10%, or even 25%. This approach focuses on high stock allocations to capitalize on long-term growth. However, as you approach retirement, the idea is to increase your bond holdings to reduce the risk and stabilize your portfolio, smoothing out the ride as you near your retirement. While the classic 3 fund portfolio has been a popular and solid choice for many investors, there are 3 significant issues that can arise with this approach. While this strategy seems solid in theory, a closer look reveals that it doesn't always hold true. So let me explain. Because in recent years, we have experienced a low yield environment, which has led to bonds not performing as expected. And as a result, they may not provide the protection you were counting on. For example, over the past decade, the Vanguard Total Bond Market ETF, the BND, has averaged an annual return of just 1.62% over a 10 years period. And you might say, but Maurice, I keep bonds to make my portfolio less volatile, not to earn big returns. And while this is a valid point, that's where a lot of investors face problem number two. So let's take a closer look because it's really important that you get this right. In 2022, when the stock market dropped sharply and a food dropped by a 18.15%, this is what happened to most bonds. And what a lot of investors didn't expect, the Vanguard Total Bond Market ETF, the BND, a popular bond ETF, actually lost about 13% that year. So even though bonds are supposed to be a safe haven, they didn't provide the stability many people were hoping for during that market downturn. And this brings us to the third major problem, which is significant for those nearing retirement. So let me explain. By holding more bonds, you aim to create a more stable cash flow and avoid having to withdraw money from your portfolio during market downturns. But because of this low yield environment, you didn't get a stable cash flow in the first place and still had to withdraw money while their portfolio seriously plummeted. And importantly, you don't need to be a technical analyst to see that bear markets were much shorter and shallower than bull markets. The chart reveals that the average bull market in the S&P 500 lasted 4.4 years and returned at 152%, while bear markets typically lasted only 11.3 months and resulted in a loss of 32%. So why set up a portfolio focused on safety during a short period of downturns only to miss out gains during the longer positive periods? And I understand this is a lot of data to process, and bear markets can vary in duration and impact. However, to keep it simple, remember if you examine longer term data, you will find out that bull markets rise about 75% of the time, while bear markets occur roughly 25% of the time. So if you found this information helpful, be sure to subscribe. By subscribing, you will receive regular updates on strategies to maximize your returns, optimize your investments, and fast track your journey to financial freedom. So I got a lot of questions from clients and people who want to achieve financial freedom in my community saying, how do you optimize your portfolio in your 30s but also in your 60s to have solid returns without sacrificing stability and safety? So the question is, when you have a long road trip to go and you are in your 20s, your 30s, or your 40s, should you invest in bonds? So while it could be really important to have the ability to tap the brake when you hit a bear market, the other side of this is as follows. If you spend too much time with your foot on the brake, you will never reach your destination, or sometimes not as quickly as you could. Let this soak in. That's why young investors often keep their foot more on the gas with a heavier allocation to stocks, allowing them to maximize growth over time, knowing that the journey ahead is a long one. But here's the thing. What if I told you there is a better way? So what if there is a way to simplify your portfolio, potentially boost your returns and still maintain a level of safety? The key here is, and this is really important, finding the right balance, and if you do this the right way, then it allows you to grow while still providing a reasonable level of protection in your portfolio. And you can think of this new 3 ETF portfolio like a Swiss Army knife for investing. Simple, flexible, and surprisingly useful. But here's the kicker. This isn't just about simplicity. It's about maximizing your potential returns while keeping risk in check. How? Let's dive into the details. This new portfolio consists of 3 components. 1, foundational ETF. Number 2, a growth ETF. And number 3, a dividend ETF. For the foundation, we are looking at something like the VTI or the VOO, which gives you broad exposure to the US stock market. This is your stability play, providing a solid base for your investments. Next up is the growth ETF. Think about the SCHG, the VUG, or the QQQM. These are designed to capitalize on growth opportunities in the market. They are your ticket to potentially high returns, focusing on companies that are expected to grow faster than average. If you want to be more diversified and have more international stocks, I have this video for you. We dive deeper into the latest performances of international versus US stocks. Finally, we have the dividend ETFs such as the SCHD or the VIM. These focus on generating income while also providing some level of capital appreciation. It's like having a steady paycheck from your investments. Now, you might be wondering why this specific ETFs? Well, it's all about balance, and this combination gives you a mix of safety, growth potential, and income. It's suitable for a wide range of investors regardless of age or financial situation. So let's talk about performance. By including a growth focused ETF like QQQ or its cousins QQQM, we are aiming for those higher returns that can really move the needle on your wealth. You would have seen a 418% return over 10 years only in QQQ. And I know it's always easy to look backwards, but that's not my point. But what about risk? Isn't this approach more risky than a traditional tree fund portfolio? Not necessarily, because the dividend ETF can provide the break you need during market downturns with the income you need. But when you do this, there is one simple trick to make it much safer for yourself, and that approach is this. Keep 3 to 5 years of worth of living expenses in a high yield savings account. Depending on your situation, this cash lets you ride out market storms without touching your investments. In a normal situation, you would rely on your brakes to slow down when the ride gets rough. But in this scenario, the dividend ETF acts like those brakes, providing a steady income during market downturns so you don't have to sell your investments at that time. This cash reserve will do the work, helping you navigate through market dips smoothly. Now, let's get personal, because asset allocation is all about your unique situation. Your ideal 3 ETF mix portfolio isn't set in stone, right? It evolves with you over time. So let's start with the optimal asset allocation by age. If you are nearing retirement or financially independent, then your focus should be on protecting your capital and generating income. At this stage, safety is key. A solid allocation would be 50% in a dividend ETF, 40% in foundational ETF, and 10% in a growth ETF. But here, the important part is to keep 3 to 5 years worth of living expenses in a high yield saving account to help weather market downturns without selling your investments. But if you have enough money coming out of your dividend cash flows, also when the market dropped 50%, it could be a reasonable decision to reduce your cash stack. If you are 10 years from retirement, then you will need a balance between growth and safety, since you are close to needing that money. This means you should shift more towards dividend and foundational ETFs to reduce risk but still seek moderate growth. A smart strategy is 40% in a dividend ETF, 30% in foundational ETF, and 30% in a growth ETF. And don't forget to have at least 3 years of expenses set aside in savings. For those with 20 years until retirement, it's time to focus more on growth. A good mix would be 50% in foundational ETF and 25% each in dividend and growth ETFs. Keep about 1.5 years worth of expenses in savings, but your main focus is building your nest egg. If you are in your 30s or early 40s, this is your prime earning period. You might aim for an even 33% split across these ETFs. But if you are feeling confident, consider 40% each in growth and dividend ETFs. This is your chance to be more aggressive in growing your wealth. And finally, if you are young and focused on growth, then your portfolio should have a higher allocation to growth ETFs because you have the time to weather market ups and downs, and as a result, you can afford to take on more risk and aim for greater wealth accumulation. A 33% split between the 3 ETFs is a solid strategy. Think of it like planting a tree. You are giving it the best conditions to grow strong over time. So this approach isn't just about maximizing returns. It's all about adjusting to your changing needs. When you are younger, you focus on growth. And as you age, you gradually shift towards income and stability. And the best part, you are doing it all with just 3 ETFs. It's simple, effective, and tailored to your situation. So if you are hungry for more insights on this 3 ETF strategy, check out my video, Best 3 ETF for Long-Term Investing that will make you rich. It's packed with additional data and analysis to help you make the best informed decisions when you are looking into your portfolio. And remember, your financial future is in your hands. This improved 3 ETF portfolio isn't just about simplicity, it's about taking control and building long term wealth.